The unsettling news out of the Middle East has many of us wondering how to safeguard our retirement portfolios as we plan for the future. Hello, I'm John Shrewsbury with the fastest 4 minutes in finance. Scott is on vacation. How you might strategize your way through market volatility and global turmoil really depends on where you are on the journey to retirement. For accumulators, the power is in patience. If you're wealth building, meaning you're more than 5 years out from retirement, your job is to stay focused on your goals. You're building that nest egg and you're watching the news, seeing the market swing up and down. It's tempting to panic, isn't it? To think maybe I should pull my money out. But there's a mistake that I see people make all the time, moving away from what works when the market's bumpy. They do the wrong thing at the wrong time for the wrong reason. Think of it like this. You're buying shares of mutual funds or ETFs, right? When the market is volatile and the prices are lower, it's actually an opportunity. You're buying more shares for the same amount of money. This is the essence of something called dollar cost averaging. It's not a guarantee against a loss, but it is a tried and true method for building significant retirement assets over time. I've seen it time and time again in my career. People moving to cash when downturns happen and then staying there, even when things settle out. And almost every time that decision costs them precious growth, causing them to miss on some of the market's best rebound days. So my advice for accumulators, put your head down, keep investing, and get that company match on your 401k and ignore the daily balance on your phone. Trust the process. Now, if you're near retirement or you're already enjoying it, you're facing a whole new set of risk you likely haven't ever encountered before. First, there is timing or sequence of return risk. We have no crystal ball to predict the future returns, but imagine this. You're taking income from your portfolio and then suddenly the market takes a dive and you're forced to sell assets at a low point just to get the income that you need. That's really a tough spot to be in. Then there's the risk of living too long. I know that sounds funny because we all want to live a long and healthy life. But the longer you live, the more your retirement funds are strained to sustain your income. And finally, there's inflation risk. When you're working, wage growth often keeps pace with or even outpaces inflation. But in retirement, prices still go up, and it's your portfolio that has to provide that increased income that you're going to need in the future. It's a tricky balance, isn't it? Timing risk might want you to be super conservative, but longevity and inflation risk push you to stay invested in equities for growth. So what's our prescription for this complex puzzle? We call it the bucketing approach. Imagine this. You have 3 buckets lined up along the timeline of your retirement years. Bucket 1. This is your immediate income. It holds highly liquid, low-risk assets, enough to cover your expenses for a 5-year period. Think cash or short-term bonds. At the other end of the buckets is bucket 3. Now, this bucket holds more growth-oriented, riskier assets, like equity mutual funds and ETFs. These are the funds that you won't need for many years, allowing them to ride out the market fluctuations and continue to grow. Bucket 2 is in the middle. This bucket has a balanced approach, a mix of less risky and more growth-oriented investments. The key to this strategy isn't just the setup, it's the execution. You always take your income from bucket 1, and then here's the genius part. You opportunistically refill bucket 1 with profits from buckets 2 and 3. That's happening when the market actually performs well. Conversely, you leave buckets 2 and 3 alone when the market is down. This plan helps you avoid selling equities when the market is unfavorable, effectively mitigating the sequence of return risk. At the same time, you're using those growth assets in the later buckets to protect against longevity and inflation risk. It's about having a plan that removes the emotion and gives you a clear strategy. knowing you're prepared for whatever the markets throw your way.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.